If you are chasing reliable monthly income without abandoning stocks entirely, JEPI deserves a hard look right now. This is the JPMorgan Equity Premium Income ETF, and as of late July 2026, it is still delivering an 8% distribution yield while holding a portfolio of large-cap U.S. stocks. Today I break down exactly what JEPI is, the clear bull case, the real risks, including NAV pressure, the latest performance numbers, and how it stacks up against SPY and its NASDAQ sibling, JEPQ. No fluff, just the facts you need to decide if this income machine belongs in your portfolio. JEPI is an actively managed ETF from JPMorgan, designed to deliver high current income while still giving you some equity exposure. It runs two engines. First, it holds a portfolio of roughly 100 low-volatility, large-cap U.S. stocks. These are quality names selected for lower beta rather than a pure market cap-weighted S&P 500 basket. Second, the fund uses equity-linked notes, or ELNs. These notes effectively sell out-of-the-money call options on the S&P 500. The premiums from those calls, plus the dividends from the stock holdings, are distributed to shareholders every month. As of late July 2026, the trailing 12-month yield sits around 8.05 to 8.1%. That works out to roughly $4.57 per share over the past year. The July payment was in the 39-cent range. Payouts fluctuate with volatility because higher implied volatility produces richer option premiums. The expense ratio is 0.35%, and assets under management are over $45 billion. The bull case is simple. You get an 8% yield paid monthly, far higher than the roughly 1% on SPY. That cash flow arrives in up, down, or sideways markets as long as there is enough volatility to support option premiums. JEPI's stock sleeve is deliberately lower volatility than the broad market. This has historically produced smaller drawdowns than the S&P 500 during corrections. In choppy or modestly rising markets, the combination of stock dividends and consistent call premiums can deliver solid total returns with less drama. For anyone building a retirement paycheck, the monthly cadence is a real advantage. You can live off the distributions without selling shares. The strategy has scaled successfully past $45 billion in assets. JP Morgan's active management also lets the portfolio tilt toward higher quality, lower beta names, which has helped in risk-off periods. If your primary goal is high current income with equity exposure, and you are willing to give up some upside in strong bull markets, JEPI does exactly what it was built to do. The risks are real and structural. The biggest one is capped upside. Because the fund sells call options through the ELNs, strong rallies in the S&P 500 leave money on the table. JEPI simply cannot keep up with SPY in a powerful bull market. That creates the NAV discussion. Distributions are not classic return of capital in most periods, but total return has consistently lagged the broad market. Over multi-year stretches, the share price has stayed relatively range-bound while the fund paid out high yields. If you need both high income and meaningful capital growth, the opportunity cost adds up. Distribution amounts have also trended slightly lower on a trailing basis in recent years. Tax treatment is another issue in taxable accounts. Most of the distribution is ordinary income from the ELNs, not qualified dividends. That means higher tax rates for many investors. Hold it in an IRA or other tax-advantaged account when possible. Finally, the strategy depends on volatility. Prolonged low volatility grind higher markets, shrink option premiums. Stock selection risk also exists. The active low vol tilt can lag when high beta growth names lead, which is exactly what we have seen at times through 2025 and into 2026. As of late July 2026, JEPI's year-to-date total return is only in the low single digits, while SPY is up closer to 9%. The one-year gap is also clear. Versus JEPQ, JEPI offers lower yield and lower volatility with a more defensive stock sleeve. JEPQ currently yields around 10.7% and has captured more of the Nasdaq upside. Choose SPY for maximum long-term growth. Choose JEPQ if you want higher income plus tech exposure. Choose JEPI if steady monthly cash flow and lower volatility matter more. Here is my own position. I have been buying JEPI since June 2021. Net cash invested is $3,465. Current value is $3,375. Market gain is negative $89, but dividends earned total $314. That puts total gain at $225 and a money-weighted return of almost 35%. The July dividends alone were over $23 across the position. Income has more than offset the modest principal decline. I plan to add JEPI to my priority to fund list going forward to help make the overall portfolio more stable. JEPI is a high-quality income tool, not a growth engine. Use it for the monthly paycheck it was designed to deliver, preferably in a tax-advantaged account, and size it appropriately. If this breakdown and the real numbers helped you, hit like, subscribe, and drop a comment with the income ETFs you currently hold. See you in the next one.